I would like to start, maybe I will introduce the panel. I will start by introducing John Newlands, who's been for more than 18 years in the investment trust, listed investment companies industry, and he's with Brewin Dolphin, and he's just going to give a very small and short introduction of how listed private equity came into life in UK and what can be conclusions driven from that example.
Yes, thank you, Nikos. My company's on the buying side of listed private equity funds and other types of fund, but I also have a secondary interest in financial history, and I think I'm just going to put a very small number of slides up here, going right back to the start to tell you how the whole thing originated, in my opinion. And this slide shows the 1930 in the UK, tens of thousands of unemployed people in Trafalgar Square on the left, and on the right there was a thing called the Jarrow March, where unemployed workers walked from the north of England to the south of England to protest about the extreme economic conditions. And obviously there are some reflections of what's happening here today. And as I say at the bottom there, UK unemployment hit 20% by the end of 1930. So what did the government do about this? Well, they decided to set up a thing called the Macmillan Committee, and the aim was, as it says on the slide here, to decide whether the banking and financial system was actually helping trade and industry or hindering trade and industry. And looking at those four gentlemen, there was Lord Macmillan on the left. He was a Scottish judge. He was a member of the Conservative Party. Ernest Bevan, second right, he was a very senior Labour politician. The man on the right, McKenna, he was a Liberal. And Maynard Keynes was the great economist, so that was a pretty powerful little group. They concluded that big corporations could borrow millions of pounds, they could negotiate, they had the teams and all the rest of it. Little local businesses could go to the bank and maybe borrow a few thousand. There was this huge funding gap in the middle, and I think this is probably the first occasion when this funding gap was actually identified properly, and it's been known ever since as the Macmillan Gap. Now, several things intervened. It took a long time anyway, government committees and so on, and the Second World War. But in 1945, two separate committees were set up, initially financed by banks and the government in a sort of collaboration. And as it says here, one was for small companies, the ICFC, and the other one was for larger companies, that was the Finance Corporation. And these two merged in 1973 to become Finance for Industry. That became Investors in Industry, hence the name 3i today, which is this massive listed private equity vehicle. So that's the dawn, really, of the listed private equity sector. Now, this is practically my last slide, really, but I just wanted to illustrate using this slide that some of these listed funds are extremely large and liquid. I've put total assets here in millions of euros. We've got Electra there on the right, 2.3 billion euros, for example, and many of these are London listed, but some are listed across various other European countries, and this is pretty big business. So that's the end of my message. I'll now hand over back to Nikos. Thank you.
Thank you, John. Now let me introduce the panelists, starting with Nicola Reddy from Vertis, private equity and venture capital investment director in that company with a big with a large experience in the sector. Hannes Stakats from EBRD, having a vast experience in the region in different positions, from infrastructure, for crowdfunding, for SMEs. Russell from one of the Foresight Capital, which is one of the SMEs-oriented private equity businesses in London, with experience also in VCTs, listed VCTs. And of course, John and Michel, who we've already introduced. I will start first with a question to Russell and Nicola. starting with Russell's. The question is, there are two questions. Basically, if you can briefly introduce to what type of companies you invest, and what are the criteria you use for them, the three most important criteria, and how you help the companies grow.
Great, that's quite a large question, I think. So if I start off with what we invest in, as Nikos mentioned, we manage a number of listed VCTs. These are UK Stock Exchange listed funds from around 60 million euros up to about 120 million euros per fund. And we're entirely focused on small companies in the UK, so I can't comment on anything in Greece at all. But in the UK, we're focused on investing in companies with revenues of up to about 20 million euros. Typically established businesses, profitable businesses, and we're looking for companies with some form of sustainable competitive advantage. That's often reflected in the gross margins that they can charge, and we look at all sorts of investment types as well. So growth capital, relatively early stage, all the way through to acquisition finance, management buyouts, management buy-ins, and equity release transactions. In terms of what we're looking for in the companies, I think the quality of the team is a very important factor for us. But I have to say, dealing with small companies, you quickly realise that saying, oh, it's all about the team is actually completely incorrect, because the companies that we see normally have gaps in their team, and they've almost been successful despite the gaps that they might have in their team. So part of what we're always looking for is, where do we think we can add value? Either in supplementing the team, making some changes in it if necessary, introducing new external people, executive and non-executive. I think the other key thing that we look at is the market. We want companies that are active in large, ideally growing markets, benefiting from a rising tide generally, even if they're not that successful individually, although we'll obviously hope they will be. And very important to us is actually exports as well. So about 80% of our companies derive around half of their revenues from exports. And for us, that's a key part of managing the risk of being too tightly tied to the UK economy at any one point in time. I've gone way more than three things that we look for in companies, but the business model is really important as well. So we want some sort of scalable business model. We invest small amounts of money, up to about 7 million euros. So there's no point us investing in a drug discovery company that's going to need 50 or 100 million euros. We're the wrong sort of investor for those companies. And then scalability in terms of operational gearing is very important as well. That's a way to really increase the value for the business as we work with it over typically a 3 to 7 year period. I suppose most importantly probably is quality of revenues. So where possible, recurring revenues or repeat business, not too much customer concentration. But for every example I've listed, we've got about 35 investments live at the moment. You could point to any number that break any one of those rules. As I said, it's really about seeing an opportunity to strengthen a business that's already successful and take it on to the next level. And we understand that at the time we're investing, there are going to be problems and issues with the company's strategy, its team, or its business model. And that's part of our challenge and where we have to try to add value. Crucially for us is exit. We meet a number of companies that come to us and say they'd like to raise 2, 3, 5 million euros. And when we delicately bring the subject round to when do they plan on selling the business, who might want to buy it and so on, they'll give us a shocked look and say, well, of course, I want to hand this on to my grandchildren. Well, that's a perfectly admirable aspiration and ethos for any business, but obviously it makes it entirely inappropriate for a private equity investor. So that's another one of the key criteria that we look for. If I ramble on into how we help them grow, I think the first thing is by sorting out the team. So very often we'll bring in a non-executive chairman, much like put in place a non-executive board around the team. And finding the right individuals has an enormous impact on small companies. Small companies very often tend to be inward-facing, and so bringing someone into the business who can talk about their experience in many other companies adds enormous value and brings perspective that SMEs often don't have themselves. We look to professionalise the businesses, which sounds a bit patronising, but that means monthly board meetings, financial reporting, clear policies, fairly fundamental things, but a large number of successful SMEs get by just fine without those. They can grow to 5 or 10 million euros, and there's really no need. And occasionally we even meet companies that have no management accounts at all. The owner just checks the balance in the bank account at the end of the month, and if it's fine, then he knows it's going okay. And again, that grows a business to a certain stage, but it's our job to identify companies we can take to the next level. Sales and marketing tends to be an area where SMEs, in our experience, underinvest. Particularly owner-managed businesses where the founder may be an engineer or a technician of some sort will have grown their business through quality of service, word of mouth, quality of their products, and they don't really like salespeople, and they don't really like spending money on a website that could go into paying for their next holiday or their mortgage or so on. So that's one of the areas where we very often find we're doubling, tripling, quadrupling the size of a sales and marketing team. But again, just as importantly, professionalising those processes as well. Acquisitions are a very common source of growth for SMEs. Making small acquisitions, typically you'll pay a much lower valuation for a business. That's something where a private equity-backed firm can grow quite quickly and quite effectively compared to its competition. International expansion, crucial of course. I talked about exports. We've helped many companies, particularly into the US, but occasionally into Europe as well. And it's not that we know how to do it, but we've certainly seen plenty of examples of how to get that wrong. And I think very often with the way we work with companies, it's as much about helping them avoid mistakes that we've seen hundreds of other SMEs make. That adds as much value as having some brilliant strategic idea. And I suppose that the key to private equity in my mind is around incentivization of management. So very often owner-managed businesses, there'll be very little equity or profit share put in place for the senior management team of the business. And when we invest, obviously by the nature of the name of what we do, private equity, we're putting in place incentive schemes and we're linking the wealth of the individuals running that business to the success of the company. And if they can double or triple a business in size and sell it successfully, they're going to walk away millionaires. And I think that's a hugely motivating fact for management teams and also for attracting in quality management into a business as well.